Hey everyone, Dylan Langei, branch manager and mortgage loan officer. And I'm going to give you two reasons why, if you're either a buyer and you're wanting to lowball a seller, or if you're a seller and you're needing to do a price drop to sell your home, I'm going to give you two big reasons why you should not use that strategy. There are better strategies that will ultimately help you sell your house. And if you're a buyer, will ultimately help you save more money long term than just going in low on the purchase price and or dropping the price. So let's just use this for an example. Let's say that I'm interested in purchasing this house. The price cut was, got my attention. They dropped it $22,000. But this was about 3 weeks ago, right? Home is still listed, still no nibbles on it, no pendings. And this property is actually right down the road from me. It's in Bellingham. And so let's say that I'm, a savvy buyer or a savvy real estate agent, and I know that the Bellingham, the sale to list ratio is 98.3%, right? So what that means is most likely I can get this property under contract for 98.3% of the list price. So the list price is $499, right? Times 0.983. That's $490,000. So I could get about, $9,000, $10,000 off of the purchase price. Okay. So what does that look like, right? If I offer this seller $489,000. So let's look at what it looks like if I offer $499. Okay. And what the monthly payment looks like. Then let's look at the monthly payment if we drop the price $10,000. So if you do $499, and let's just do a 5% down scenario, okay? A 5% down scenario, that leaves you with $474,000 that you're borrowing. Let's say you've got, 740 credits on this property. This is on today's pricing on a 30-year fixed. And so right here, let me just explain. There's a lot of numbers on this screen. Here's the interest rate, your APR, your principal and interest payment. So just your principal and interest, not taxes and insurance. This is how many points you're paying or receiving in a rebate. So 7.375 right now is at a zero cost. So you'll see zero right here. 6.5% is going to cost you $5,300, right? And the principal and interest is $2,996. So let's use this 7.375 and let's just compare a $10,000 price drop. So our monthly payment is $3,274. At $499 with 5% down. Let's say that I'm feeling super savvy and I want to offer them $10,000 less because I know that the sale to list ratio is 98.3% in Bellingham. So I already did the math on that. If I offered $489 and did 5% down, this is how much I'm borrowing. $464,500 on the same 30-year fix at 7.375. The principal and interest is $3,209. So let's do this. Let's see what the difference is. So 3,209 minus the same 7.375 was 3,274, right? At the $10,000 higher price. So 3,274. I'm saving $65 a month for a $10,000 price drop. So let's see what the break-even point is on that. So if you do $10,000, that's, what you're saving in the cost, right? The acquisition cost, divided by the monthly savings, which is $65. That's 153 months divided by 12 is 12.82 years. The $10,000 price drop, that if you're a seller and you drop your house $10,000, or if I'm a buyer and offer $10,000 less, that $10,000 doesn't break even for 12.8 years. That means I need to keep that home, keep that mortgage for 12.82 years before I start realizing the gains of that $10,000 price drop. Okay. I don't really like that because most people live in their home for 5 to 7 years historically. So I don't like a break-even point that's over 7 years. So let's see what a better strategy would be. And there's two strategies that are way better than a price drop or than offering, lowballing a seller, depending on if you're a buyer or a seller. One of those would be to permanently buy down the interest rate via a seller credit. So if you're a seller offering a seller credit, or if you're a buyer requesting a seller credit, is going to move that needle way further. So let's look at this. 7.375, the rate, costs $0 to the buyer. 6.5 costs $53.33. That's a one-time closing fee, $5,333. Your principal and interest, though, is $29.96 versus $32.74. So let's see what the difference is, and let's see if the break-even point's better than 12.8 years. So we do $32.74 minus $29.96 is $278 that I'm saving per month for $5,300. So that's half of the $10,000 price drop, but I'm saving $278 instead of $65 a month. So let's do that. Let's do 5,333, right? The cost that you're asking for the seller divided by the savings, the 265. That's 20 months divided by 12 is 1.6 years. That $5,300 breaks even. So I only need to keep my mortgage for 1.6 years and not refinance, not sell, and I've broken even on that $5,300. I like that break even point way more than 12 years. Way more. I'll take that any day. Okay, so that's option number one, permanently buy down the interest rate. Now, I think at this point, you need to watch my video 2 videos ago, have mortgage rates peaked. That will drive your decision if to permanently buy down the rate or to do the second option, which is a seller buy down. So similarly, I've got the sales price still at what the seller's asking for, $499, because I'm going to negotiate via seller credit. Doing 5% down, let's just use the interest rate of 7.375, which was, this rate at zero cost. So this is your principal and interest, is $32.74. So there's 3 different programs. There's a 3-2-1 buy down, a 2-1 buy down, and a 1-0 buy down. The easiest way to explain these is the seller is prepaying the borrower's mortgage for 1 year, 2 years, or 3 years, a portion of it. They're subsidizing it. Okay, so in a 1-0 buy down, if the starting rate is 7.375, the seller is prepaying the mortgage payment for 1 year, the first year, to get the rate 1% below the starting rate. But they're just prepaying that mortgage payment to get that monthly subsidy of $316 you're saving per month for 12 months, which is $37.98. So we'd need a credit of $37.98 from the seller, and you would save, right? Your mortgage payment would be $29.57 instead of $32.74, because you're basically having the seller prepay $37.98 in your monthly payment. On the 2-1 buy down, for the first year, it's 2% lower, and the second year, it's 1% lower, and they're subsidizing those payments. So in this scenario, we would need $11,000, but I'm saving for the first year $619 a month, and for the second year, $316 a month. So if you're somebody that believes that mortgage rates are going to go down in the next 2 years, this 2-1 buy down is a better option than permanently buying the rate down, because you're front loading the savings, right? You're using that seller credit to front load the savings rather than in the other option. I was, when I'm permanently buying it down, I was saving about $250 a month. This one, I'm saving $619 a month, right? So I'm front loading my savings. And the 3-2-1 buy down is 3% lower the first year, 2%, and then 1%, but a much bigger seller credit because you're prepaying for basically 3 years, you're subsidizing. So those are 2 options to save more money rather than asking for a price drop, or rather than lowballing the seller. Permanently buying down your interest rate or doing a seller buy down program are way better, if you look at the break-even points, way better options than getting that lower purchase price, because it's a long-term loan, right? So when you're getting a $10,000 price drop over 360 payments, if you're doing a 30-year mortgage, it doesn't move the needle that much. But if you do a seller buy down or permanently buy down the interest rate, it moves the needle a lot more. So watch my previous video on if mortgage rates have peaked. Do your own research to see which option is best for you. Let me know also in the comments what you think, and then share this with anybody that you know that's maybe got a home that's listed or is looking at purchasing a home. Any friends, family, coworkers, share this video and make sure that they know about seller buy down options and rate buy down options, rather than just automatically trying to lowball or price drop on their home because of what sale to list ratios are doing right now. If you have any questions, feel free to reach out to me. I'd be happy to chat with you and walk you through some different options for your particular scenario. Thanks so much. Tune in next time for the next video.